The private debt market, the direct debt market, crossed the $1 trillion threshold last year. And if you combine this with the broadly syndicated BSL market and the high yield market, this makes for an addressable market north of $5 trillion. So the confluence of bank regulation and large pools of capital have absolutely transformed the direct debt market into a deep market with a diverse set of borrowers. And it offers investors a huge array of opportunities in which to achieve their income goals. But it is also no secret that these large capital inflows and an accommodative Fed have increased the risk profile of the underlying market. So if, for instance, we look at the percentage of covenant-light loans in the market and how it's evolved over time, or if we look at leverage levels and how they've crept up, one might reasonably expect that these riskier profiles would be associated with an increase in margin. But in fact, margins have compressed as well. I don't want to sound overly alarming. There are plenty of meaningful mitigants in the debt markets. So for instance, if we consider equity cushions or equity contributions, remember this is the capital that's below us as lenders, you can see that equity cushions have actually remained remarkably stable and perhaps even increased over the last handful of years. But in an environment in general in which leverage is creeping up, financial covenants are being weakened, and macroeconomic risks still exist, we've generally started to think with a defensive mindset first. Without exaggeration, let's consider the current macroeconomic environment, the global pandemic, supply chain disruptions, increased inflation, the crisis that's going on in Ukraine, both humanitarian and economic, a Fed that's actually potentially behind the curve, maybe substantially so. So while we still find good, solid investment opportunities in which to invest your capital, we think it's appropriate to have a defensive mindset.